Welcome, everybody. I'm delighted to have back for a second visit with us, Sam Burns of Mill Street Research. Sam was pretty accurate. I have to say, sometimes people don't like the messenger. We all wanted doomsday. We all wanted black pill. We all wanted, fire and brimstone. And in actual fact, Sam's overall take on his last meeting with us when he spoke is that potentially people were a little bit too gloomy. He's actually been shown to be pretty accurate. The stock market has moved up quite substantially. And we are here to get to welcome him back and to get his revised take as someone in form on how he sees us going forward. Welcome back, Sam.
Oh, thank you for having me, Francis. It's been a pleasure.
So first of all, congratulations, good positioning there. You liked the stock market actually, and you will have been very richly rewarded, and your clients will be too. So don't forget, anyone watching, check out Mill Street Research. But what's your take now? I mean, it seems to me, let me set this question a little bit of a setting without being too long-winded. It seems to me the Feds and central banks generally are peddling back the notion of this vast pivot. I suspect because of debt markets, because who's going to be the biggest buyers of debt if the rates have to come down so far? But there may be other reasons. Maybe you have a different take. Despite that, the stock markets have done exceptionally well. We had NVIDIA earnings, and despite a little bit of dis-ease going into it, it seems to be at new highs. You're talking about a 1.7 trillion market cap company as one, and you liked tech as well at the time, which means you've again done been spot on since we last had you on. How's your read on a couple of those levers, both the central bank's positioning and maybe a comment on the tech markets, how you feel about them now?
Sure. No, it's very kind of you to highlight the past views. And yeah, it has been, a much more bullish period than a lot of people expected. When I was talking to a lot of people, end of 22, early 23, the bearishness, the negativity was quite palpable. And I think that's part of what set up, the better gains this year is that the bar was very low in terms of economic activity and earnings, in terms of expectations. So it didn't take a whole lot to do better than expected. And we actually did quite a bit better than expected in the U.S. Now that's less true maybe overseas, but for the U.S. market and U.S. economy and everything, it's definitely been a better than expected view. Now coming into this year, things still look pretty good economically and earnings wise. What I've been telling people is that the soft landing, people have been kind of, the fabled soft landing is in fact here. In my view, inflation is essentially back to target or will be very soon. We've avoided a recession and avoided a sharp rise in unemployment. The boxes have been checked. Now, anything can always go wrong in the future, but I think that most people had written that off as a possibility and are now having to kind of, agree that that is in fact happening. And that's caused investor enthusiasm, optimism, valuations, all that sort of thing to be higher now coming into 24 than they certainly were coming into 23. I think a big part of that has been the Fed kind of pivoting their messaging from being, either more rate hikes or higher for longer, which we kind of got in the, summer and fall of last year. And that's really what that whole August, September, October decline was the market adjusting to expecting higher rates for much longer. Once the kind of, inflation data started to get better in November, December, and the Fed switched its messaging, that's what's really set off this latest rally over the last few months. And I think is what's going to help, kind of keep a floor to some degree under stocks and the economy, going into this year is that if the direction of rates is stable to lower, then that's the key. Exactly the timing of when they cut or how much and all that is much less relevant, I think, for the economy and the market. If you're a short-term interest rates trader, of course, it's relevant. But for the big picture, it's much less relevant. If the direction is down, then that's the key. And I think there are several reasons for that, but I think that's the big macro theme. And then earnings and underlying growth are still, pretty solid. And that's been, an ongoing theme. I think will continue for a while longer.
Interesting when you say, for example, earnings growth is one of solid. I put myself kind of in the camp that still thinks there's going to be a hard landing. And that's why it's great to have someone with a contrary view to mine to stress test that. How come and I'm a bit curious by this, in this, I suppose, export-orientated world, we've got the UK in recession, we've got largely the EU in recession, we've got disinflation in China, which probably points to the fact that there's some element of recession. We don't know what degree the Chinese stats will illustrate and how much of that message gets out. World trade generally should be a tough place. How do you see the US having been so insular and so robust in an environment where major trading partners such as China, Germany, Japan as well, I failed to mention, and the UK as what were combined in with the rest of the EU, I suppose. Surely we always used to say, America sneezes, the rest of the world gets a cold. But if you've got the rest of the world all sneezing, is there not a little bit of blowback there for the US as well? How's it turned out that they've done so well? Let's put it that way.
No, you're absolutely right that the rest of the world is doing much less well than the US is, broadly speaking. And there are kind of different reasons for different regions in some ways. Europe's had a lot of structural issues for a long time, having a single currency and 20 different fiscal policies. China's had some structural issues for a while and it really got worse after COVID, but has been continuing to get worse. So I think part of it are big long-term structural macro differences between the U.S. and the rest of the world. And also, the U.S. trade makes up a lower percentage of the U.S. economy than it does for most of those other markets you mentioned, particularly places like Japan, but also Germany or the U.K. They're smaller economies that have to do more trading, or their exports and imports are a much bigger proportion of their economy than it is for the U.S. The U.S. is just a much bigger domestic market, and the U.S. of course has its own energy, which Europe and Japan and a lot of other places do not. And that recently, of course, has been a much bigger factor in terms of influencing relative economic growth and the kind of the costs that they're facing. But I think a lot of it is sort of structural in the background. And the fact that I think one of the big swing factors for the U.S., the reason why we've done not only better than other countries, but also better than past U.S. economic cycles, given that the Fed has raised rates 500 basis points and all these other things, is that fiscal policy in the U.S. has been much more aggressive and much better targeted in some ways than whatever they were doing in other countries. That both the post-COVID stimulus and then the second round from the Infrastructure Act, the CHIPS Act, the Inflation Reduction Act, those have all had a much bigger impact from kind of late 22 onward to not only keeping the economy kind of going, but also expanding the supply side of the economy. So building factories and infrastructure and things that help not only keep people employed, but also bring inflation down over the longer term. Those investments and things have not been made elsewhere in the same way, because again, a lot of places don't have the coordinated fiscal policy or just haven't done it. China is almost the opposite in some ways, in that they overinvested in infrastructure and real estate and underinvested in the household sector, and have built up a lot of debt and built up a lot of things, basically built roads they don't need and houses nobody can afford to live in and all these things. And that's all kind of coming due now. And so that's why I think commodity prices have been under pressure, and to some degree trade as well, geopolitically. China has made itself less attractive for global investment. You mentioned Japan. Japan is technically, I guess, in recession in the sense of 2 quarters of negative growth, but their earnings are.
That used to be the definition, by the way.
Right, yeah, right. But now, per capita it may not be, but also their stock market just made a 35-year high, and their earnings are doing the best of all the regions that I track in terms of corporate earnings estimates. So I'm overweight U.S. and Japan. The U.S. is probably a longer term one. Japan is more cyclical, but in my view, you got to look at what the earnings are doing, what the stock prices are doing, and what's going to be the marginal mover of investor activity, not the kind of GDP numbers that tend to be backward looking or not tracking what you think they're tracking. GDP doesn't always filter down to earnings or shareholders, and China is of course the biggest example of that ever. Earnings are lower than they were 10 years ago in China, which is astonishing given the GDP growth they've had. So it's things like that, I think, that really diverge, cause the GDP and macro view to diverge from the bottom up kind of earnings and investor related view for stockholders, and that's kind of what I've kind of learned to focus on. But I think that U.S. fiscal policy has been much different than everywhere else, and there's been that's really showing up in the results.
I want to take you on that one, the fiscal policy side, because there are many commentators, and I don't have the data on this. I think being a specialist, you'll set me straight on this, but that actual fiscal tightening hasn't really taken place. This is obviously not rates based for everyone who's watching. That's monetary policy. Fiscal, in terms of that, there has been a sleight of hand where there is liquidity provision that is probably counteracting what trumpeted message of tightening has been made. Large people, now I'm not sure where they're drawing their stats from. Maybe you can color that one a little bit for us. Is that true? Is it accurate? How do we get to the real facts about how much liquidity has been taken in on the back end being handed back? What's going on?
No, you're right. There's a lot of confusion about it, and there's a lot of things that are happening now that are not typically happened historically. I think to kind of start off with, my view has been that fiscal policy is more important economically than monetary policy. That movements in interest rates and all that have less net impact on the economy than fiscal policy does. Monetary policy has a big impact on financial markets. And I think that's where people get kind of thrown off, is that whatever the Fed says in every quarter point move is very important for bond markets and therefore stock markets. But when you drill down into the underlying economy and see how all those things filter through to income and spending and consumption and investment, the impacts are much less than most people, think that they are, because there's a lot of offsetting factors. You maybe one person
outside of commercial property probably, and maybe even residential property, which is exceedingly rate sensitive. But I do think you're right. I think this feels to have been a divergence of perception. That everyone's focused on the monetary, and if there is fiscal, that's behind possibly the surprisingly high employment numbers. Unemployment down, bigger beats on the non-farm payrolls, because we've seen some big beats there, and that probably points to more along the lines exactly of your point, that things are being built and people are being hired. But it doesn't seem like it's in it kind of contrasts with headlines as well. There's a sort of duality, because we're hearing about all the big tech guys going super profitable and laying off all this defensive hiring to stop people working elsewhere and getting a little bit more leaned up. And that might be pushing up their PE ratios, which has driven the tech's share side. And I'd still like your comment there. Whilst at the same time, a lot of that is shedding is being picked up elsewhere in more mundane industries and everywhere, and it's the silent, unseen, part of the iceberg that's below the waterline, almost in the sense. And we're being too attracted by the icicles above the waterline and not realizing that there's a big base that's hidden there. Is that accurate? And what would you add on that as a comment?
No, I think you're right in that layoff announcements get a lot more media attention than hiring announcements. And the bad news definitely gets, a lot more attention. And so that's why you have to look at the kind of the macro stats and see, there's always a lot of churn in the U.S. economy in terms of jobs. Everyone loses jobs and gets jobs every month. And net, there's still been a lot of growth in employment and in wages. Yeah, some of the big tech companies that maybe have overhired, a year or two ago are starting to adjust to that. But those people are finding other jobs. And so they're keeping their profitability up, which is keeping their earnings and stock prices up. And that's, the earnings for the NASDAQ 100 or whatever have been much stronger than everybody else's earnings, in aggregate and for quite some time now. So there is a fundamental reason why the stocks are doing better. Small cap companies, for instance, have had much less earnings growth than large cap companies. So that's why they've lagged. Now, obviously, anything can go too far. You can extrapolate anything, and get too high a PE. And so I think, some parts of tech may be getting to that point here, but I think there's still, room for some of those areas, to run. It is actually broader, in my view, than just a few of the Magnificent Seven names. But there are a lot of tech companies that are kind of mid and small cap that are doing well, as well. I think that's just where a lot of the spending is going. Partly it's productivity enhancement is a big theme, and then services over goods. So, the
Just on
consumer is
that point, if
spending.
I can wail in, you're mentioning
Yeah.
even medium cap, because some of the people we noted without the Magnificent Seven, they could have actually even up to, I think, the end of last year, there may have even been a negative S&P for the year. But if we're getting tech in the medium-sized, also doing rather well, are we witnessing a bit of an AI sort of dot-com boom that's a lot quieter and hasn't been fully appreciated by retail yet? Because I know Stanley Druckenmiller was suggesting that he was going to get very invested himself. It's a bit of a lead steer, of course, by name, and on his home office, probably just with his own money, if I understand how he's working nowadays, and other thinkers like that. And has it not percolated like the internet did for 99, 2000? And actually, there's more of it going on because, of course, NVIDIA, the story is very much the banner boy for chips and AI, and it seems there's no end to its rise. Calling a top on that would be the equivalent of trying to call tops on Amazon a couple of decades ago. Is there a possibility that that's going unsold, the extremity and the degree to which AI will affect our life?
I mean, it's certainly possible. And I think, trying to sort of, call a top on something like that or make precise, projections is always going to be difficult. It was difficult in the 90s, and it's difficult now. There's going to be obviously a few big winners and a lot of people who kind of get, lost by the wayside along the way. But I think it is going to be an ongoing theme, and then it's going to be a question of, there's the people who create, hardware and things for AI like NVIDIA. There's the software development, the chat GPTs and things that employ those tools.
Yeah.
And then there's all of the other companies everywhere else in the economy that might use AI as a productivity enhancing tool. And that's the part where it's really hard to get a feel for how and when and where the benefits will be seen outside of just the tech companies that are really the core producers of it right now. Those are pretty direct, and people kind of know that. Now, I think everything else is much more of an extrapolation. But I think there's some signs, and probably will be more signs, of general productivity benefits, both from AI itself, but also from just having a tighter labor market. Historically, if you have a tight labor market, if employers have to use their labor carefully and have incentive to invest in labor-saving technology, whether it's AI or not, that tends to improve general economy-wide productivity, which gives you a higher real growth rate than everything else. That's what we had in the 90s. Is you had a much higher productivity growth rate than you did in, say, the 2010s, where it was much lower. If you start to see that, develop, then you could have a late 90s scenario, which was actually the last soft landing, was sort of 1995, when the Fed was able to cut rates without a recession, without a crisis, without anything breaking, and then you had several years of strong growth in earnings, low inflation, good economy, and the stock market did extremely well without rates having to go down to zero. In fact, they were actually higher then than they are now. So I think there is precedent for that. That was maybe that was a special case, maybe it wasn't. But if AI is coming along to kind of do the same thing that maybe the internet did and computers at that time did, you could have scope for several years at least of stronger productivity growth, better earnings growth, and all those things. And of course, U.S. big tech companies are in some ways uniquely positioned to benefit from that, but the general economy and general world will as well, if that plays out and we don't get any other giant shocks that come along, like COVID or wars and things.
I'm curious on the consumer side, because the US still exports. It runs a much larger trade deficit, so that means it imports a lot more, but it still exports. We've spoken about the weaker rest of the world, and we've also always hear about the retail consumer. And so if the domestic demand is what's kept everything going, we always hear about the domestic consumer being, I think there was over $1 trillion in credit card debt already racked up. So that should mean not too much necessary borrowing credit, revolving credit left lying around that was unutilized. And then you add the rate hikes. This is obviously where, apart from the fiscal policy, the monetary policy does bite in property home payments. But I'm assuming many of the people bought a long time before, maybe have fixed deals already at lower rates earlier. So there's probably a reduction in volume on maybe the housing market potentially. People are holding for prices. Maybe they think there's cuts, and the others are holding on buying because it's a bit expensive. So you might just have a reduction in volume without actually having a full-blown crisis. You actually need a further crisis to come to actually get a property collapse. But has the consumer driven this, or is this a government-based fiscal policy? Or is this investment that the big oligarchical majors have done? Who's doing the spending that's creating the heat domestically? I'm trying to identify where's the power, the source of the power coming from.
Right. Well, I mean, generally speaking, the source of the power is going to be the U.S. consumer. It's 60 to 70% of the U.S. economy. Has been for a while, and consumer spending growth has been a key underlying driver for the strength in the U.S. economy for a while now, in the last year or two in particular. And that's a combination of more jobs, more people are employed, and they're getting better jobs, meaning they're able to upgrade their own jobs and get higher wages, and wages in aggregate are growing. So the capacity to spend is coming more.
They're growing in real terms, though. Is
Yes.
everything growing in real terms, or is this just in inflation rebasing and in nominal terms? And where's all this credit? Because they still credit buyers, the consumers, as far as I understand. Generally, if you think of automotive and everybody wants to know their payment, nobody even knows the full absolute amount they're purchasing for. How's that coming from? And why now? If this was the facts before, why now with all this additional credit and interest rate cost would they be so alarmingly strong? I'm just stress testing the hypothesis.
No, yeah, you definitely should. And the gains in wages have been in real terms, certainly in the last 12 months or so. So wages are going up
relative to the current inflation rate, which is just around the threes, or the previous, because we had a surge where we were almost 10, we were at the nines.
Initially, there was, the inflation went up faster than wages for a little while, kind of 2021, early 22, and then inflation broke and wages kept growing. And so now wages have caught up and kind of are producing real wage gains, which is crucial, as you said, that it can't just be inflationary. But there is real wage gains going on. The consumer credit growth, the dollar numbers are big, but the actual rate of growth and the rate of consumer credit growth relative to incomes or assets or net worth is actually not that large. Bank lending credit growth is actually quite low now. It's 2 to 3% year over year. So more of I think the spending power is coming from wages and earnings and things and people having jobs than it is from excessive credit growth. Now, there's always going to be pockets of that. And then, like I said, the housing market is a little bit of a locked market right now in that the sellers don't really want to sell because they have a good mortgage rate from 2 or 3 years ago, and the buyers don't want to pay up, and buy. And so an inventory is very, very low. So
Mexican standoff, But what about the commercial? I mean, I think of all the things we were thinking of, all the pessimists, of which, as I say, I was part one, and still to a degree are. The subprime cars, whatever happened to that? Why is it not blown up? Things have gone up, interest rates have gone up. All the reason, the student loan debt. Where's all the resolutions to all the things that were problems? Or are they continuing to limp on as problems and then they'll just suddenly flare up? That's my primary concern. Have they really gone away, or are they just synchronizing to explode on us in this massive, ball of lava at some later point? Where are we with subprime cars? Where are we with commercial property that was supposed to be so badly hit? Can people get financing on those buildings? Why are we not seeing some degree of contagion? It's almost, what I'm asking is, I feel there's something that doesn't smell right, and it's almost too good to be true.
Right. Yeah. I mean, there definitely are, areas of worry and things that have been weak, commercial real estate, being one of them, office buildings. I think to some degree it's a sort of a slow moving, issue. It doesn't all come to a head at once. I mean, most of them have multi-year leases and, all these kind of things get renegotiated over the course of years. And some of the banks that have exposure to them have already been kind of hit by it. But the banking system as a whole has not. It's just not a big enough component of the whole banking system to really, be a systemic issue from that standpoint. I think there's also other parts of commercial real estate besides office buildings that have actually been doing better. Some retail areas, malls and things. Some of the places that resorts and hotels, all those kind of things. In the work I look at, the REITs that are in different segments of the commercial real estate industry. Some are strong and some are weak, but it used to be they were all weak, and now it's more of a mixed picture. So I think there is, because there's demand coming from some areas, it's just not for office buildings.
If the consumer is spending, then the malls and should be.
Subprime auto, I think, is a concern, but also again not big enough to derail the whole super tanker of the U.S. economy. And again, those kind of things tend to be a rolling, slower moving thing, unless there's something specific, and it would usually be in the banking system that would kind of set it off. Because there's just not going to be the same kind of impact that subprime housing had in 2007, 2008. So I think these are issues, but they're more containable, and they're not all going to happen at once. And so I think the fact that if incomes are growing, employment is growing, and then I think there's the capacity to pay has grown along with it. And so if your housing prices are up and stock prices are up and all those asset prices are up, there's more wealth in general to back up some of that stuff as well. So when you put it all in proportion to disposable income or to assets or things like that, the numbers don't look as bad. And so like debt service ratios in the U.S. economy, people's interest payments as a percentage of income are actually quite low still, even though interest rates are substantially higher, because the consumer balance sheet is better than it was, say, in 2006 by a good margin. And corporate balance sheets are actually in better shape generally too. So I think you're starting off from a point of less of the kind of extreme leverage in the wrong places that you had, 15, 20 years ago, and that these are containable issues that are being offset by underlying real growth.
Yeah, I suppose I must, when it comes to the sort of natural themes of mainstream media, there seemed to be a lot of fear-mongering done last year, and now there's a lot of different mood music. And I often wonder, there's a genie in the box, and then they have a few boxes, and they let them all out when they want to generate a bit of fear. And then at other times they go, no, everything's fine, and they change the mood music, and all the genies are apparently suddenly back in the box, which is usually not as usually done. And then your next suspicion is, well, at what point do they get let out again because of those structural issues that largely can't be solved, such as debt? I was just wondering, and by the way, I want to say the one thing I definitely concur with, and we've been along the Nikkei crowd for probably 5 years when 21. It's for three and a half years. Once the yen started losing its value. And we actually think that's going to be a macro cycle. It's got a lot further to go, even though it's virtually going parabolic. Many people technically will say that's the beginning of an end and a blow-off move, but we think there's going to be many more surges. Because you've got such high-quality Japanese companies that actually became very good at competing throughout the 70s and the 80s with a strengthening yen and a lot of their base costs in Japan, and selling for weaker currencies. And now what's actually happened is that same high quality corporation is now competing with a currency tailwind for the first time, where they're now earning more heavier, weightier dollars, selling Panasonic, Toyota, Mitsubishi into America, Europe, etc. And their base cost, which is still generally domestic, even though there'll be assembly plants in other countries, by a degree. So the big exporters of Japanese is our long bull. We love the sort of, it's a bit of a double up on the Japan trade, but we love the short yen, long Nikkei trade, and have done for 4 or 5 years. And we've wondered why it's got so little coverage. And recently now we found out that Warren Buffett is in on the trade. And you're the first of others to actually mention that you like Japan, although I think you were saying you preferred America more. I almost 34 years. By the way, yesterday, and we just released a YouTube on that, yesterday, this morning, Japan actually made a new high after 34 years. I'm sure you're probably aware of that, and your portfolio is singing rather nicely with all those big caps. So I was, apart from that little preamble, there's a question lurking in there. Japan doesn't have the privilege of base currency of the world. However, it is one of the most indebted nations and was offering basically spoke of yield curve control, which it kind of walked back a little, but is still trying to do to some degree, and is allowing the currency to take the hit. I sort of, when I'm explaining it to non-financial people, I sort of say, a high pressure geyser, and you've got to release some of that pressure, and you either let the bond market devalue, or you've got to take the hit on the currency, and they've really not wanted to watch the debt devalue. So we actually have an interest rate parity situation where you have first world tier one nations, all of probably fairly similar risk, and you've got the Japanese at a much lower interest rate, which means the currency is set for a sustained period of devaluation, in our opinion. And they are the most indebted of the non-base currency worlds, and they were also the first to load up in the 80s to ridiculous levels. That was almost their subprime. Their property subprime markets for Japan was 1989 and 1990 peak. And that sort of is our 2007-8. So in that sense, they're almost a full decade and maybe 17 years ahead. And now you're getting those companies that have survived in that strong currency environment now having this double whammy tailwind coming in. Is there a lesson in that whole Japanese story? And you can't conflate America as the same as Japan. And of course, as I mentioned, the dollar's central role. But is there a lesson for how things are going? Because essentially their bond market deserves to sell off, in our opinion, a great deal. And they've just decided to monetize and let the currency take the hit. Is there a lesson for everybody? Because a lot of people, it's a long setup for a question, but a lot of people on the left, particularly in economics, say the debt doesn't matter. Not really. On a day-to-day basis, it's just a number and we grow and we can print dollars and all of those kind of statements. And to me, it seems like in Japan, the debt does matter, and it's become such an issue that it's now, the interrelation with the debt market and the currency market means that the yen has been almost let go to a degree. And you're talking about not Argentina here, we're talking about a very sophisticated economy. What's your takeouts of that whole experience? And is it a microcosm of the future for other nations? And possibly, is there some lessons to take out for the US in all of that?
No, I mean, I think, well, yeah, I'd agree that, like you said, I like Japan too right now. And I think they are benefiting from, as an exporter country, from their weak currency right now. And that they've been through a lot of the, adjustments that you have to do if you had an 80s style, build up in terms of debt and kind of a dislocated economy. I think China's probably going to go through some of that now with their real estate market. And for quite a while now, I think they're kind of following along the path. And the demographics, kind of longer term, explain a lot of that. Japan's population has been shrinking for a while now, and at an accelerating rate. China's about to do that shortly, if it hasn't already. The U.S. is not there yet, but eventually probably will be. But I think overall, yeah, the Japanese scenario now is relatively favorable because they do have a much more, they have efficient, they can export well, and that they have let their kind of currency take the hit rather than, trying to let their interest rates move. I think the Bank of Japan and the government has taken the view that because of the demographics and everything else there, that rates need to stay kind of their R star, I guess you'd say, is near zero. And so that's where the rates should be. And that therefore, when everybody else in the world, or the U.S. and Europe, raise rates, there's a big gap, and that makes their currency go down. If eventually, U.S. and European rates go back down again, or get from where they are, maybe you start to see that then stabilize. The yen won't keep going down at the same rate once the yield gap narrows. But yeah, I mean, the Japanese government has issued lots and lots of debt, but then the Bank of Japan has bought half of it. So net, they don't actually have that much sort of outstanding. And they also have a different environment of, like, a lot of them, banks and everything have to own government debt. So they have a ready market for it. But I think it shows you that, a lot of fiscal spending doesn't necessarily cause a crisis. It doesn't necessarily cause inflation. And if it's spent well, it can do good things. If it's not, maybe it doesn't do much of anything. And so I think there's a lot of over extrapolation or sort of panic about debt at the federal level, at sort of the government currency issuing government level, that probably is misplaced. Debt in the private sector is where they become a concern, or excessive leverage in the banking sector, which they've now kind of gotten through most of that, I think. And in fact, they have too many companies probably on their stock exchange that are below book value and just not really returning cash to shareholders or being shareholder friendly. I think they've started to move in the direction of trying to force them to do that a little bit. Delist, basically act better or delist, I think has been sort of the attitude lately. But I think overall, the standard of living in Japan is still high, still good, and still generally growing on a per capita basis. There's just fewer Japanese people now, so the macro GDP numbers look different, and we're not used to seeing countries that are shrinking in terms of just population and everything else, and getting older. So it's a very different dynamic than what we've been used to over the last 50 or 100 years, where there's always more people and there's always more stuff going on. And everything else that's going in kind of reverse in Japan, and they're the leading edge. Parts of Europe, Italy, things like that are going that direction. China's going that direction. So I think you're going to start to see the world look a little bit more like Japan in different ways. And right now, it's just they're kind of out there by themselves in some ways in terms of pursuing a zero rate policy while everybody else isn't. But I think that'll eventually play itself out. But I think Japan still looks like a pretty good place, and it's benefiting in some ways from the weakness in, say, Japan or China or Korea, or thing where things are wildlier looking and the trade is going the wrong way.
To take you on the debt, that's not the retail, which is killing consumption, etc., but government-based debt. There's talk of, I think it's Medicaid, welfare that won't have money and run out of money at 2035. And of course, you've got the pig and the python boomers that are living longer and are no longer net contributors. And you have the fundamentals of, 60 years ago, there would be 16 young people supporting every pensioner, much as you described. We typically always had the demographic triangle like that, where age is at the bottom going up. And now we've got Japan doing that, and we've got a bit more complex pigs moving up that are now getting into very much the withdrawal stage of their life cycle out of the system. And with all of that said, it's quite clear some of these social services or programs are not going to be sufficiently funded. Actuarially, they've been warned about for decades. They're now getting to within, it's not much more than 10 years now where things are going to happen. You, of course, had the Californian second biggest pension fund, I understand, teachers' pension, elect to borrow rather than sell because of adverse effect upon the market and liquidity concerns. So we're actually talking about a market where there's not a big bid stack actually for debt. We have the BRICS nations that are no longer supporting American treasuries to the same degree. You've got a shortfall on tax versus expenditure. It's probably puts you at about 50%. You're spending twice what you're getting in terms of income approximately. And all of this is getting added, of course, onto the tab of debt and the buyers. So we're in a bit of a parabola, and we have this currently interest rate plus the Fed saying what they're going to do, which is if we cut, it's not going to be much and for long. In other words, they don't have the means to push the valuations of debt that high by dropping rates too low. It does feel very much that March 2020 was the peak debt moment, as we've put forward in many of our hypotheses. So even if you do get a pullback, it's going to be a pullback potentially in a trend of escalation. So your interest payments is bigger than the military industrial complex spend, and there's social and Medicaid problems that are running into situations where they're no longer going to be funded. They will actually be empty. They'll be selling off assets. They're not getting enough. All of these aspects on the bigger debt. Are we not? You have the long-term problem and you have the short-term problem of the consumer not having money. He's indebted. Okay, he stops spending. You get an immediate effect, a bit of a recession. Government building debt, that was kind of a long-term one that you could put away and forget about. It's somebody else's shift that's coming on. But have we not reached the point where we're on that shift, where that becomes now quite material, and that's going to require some form of entire system reset to get out, because the funds just won't be there anymore. And how do you handle that side of the doomsday argument with regards to the debt situation in America on the government side and unfunded liabilities?
Right. Yeah, no, it's certainly been a discussion point for a long time. I mean, people were discussing Social Security running out of money like 40 years ago. I think there's a financial side, and then there's sort of a political side. Things like the Social Security Trust Fund or the Medicare Trust Fund, those are just political constructs. They're not real things. They could just be made to go away. They could just, say so, and they would go away. All funding for the government is general government funding, unless you make up a reason not to. And I think, Congress could just decide to fund it out of general revenues, and then it wouldn't, there would be no crisis. It would potentially cause the deficit to be somewhat higher structurally if you didn't, raise taxes in some ways to compensate for it. So maybe Social Security or Medicare taxes, payroll deductions have to go up, either by raising the rate or eliminating the cap on them and things like that, which they've done in the past, which would stabilize the system, for a while. But I think in general, the question is, kind of what are the alternatives to that in terms of, do you want to cut benefits? Do you want to raise taxes? Or do you want to just run bigger deficits? Probably some mixture of the three is what's likely to happen. But it doesn't necessarily have to be a crisis or to restructure or reorder the whole system. The federal government can spend whatever it wants, as a fiat currency issuer, and so nothing is going to force it to do that unless the politicians decide to just make it happen. That's like the debt ceiling and these other things that come up that are just sort of political man-made things that aren't a real reason for a crisis. They're just a political thing. So I think it's important to kind of keep in mind the real constraints versus the kind of just politically made up constraints, and the reasons that have been historically there about trust funds and all that kind of thing running out of money. Again, that was a way to sell the program or something. It's not an actual way to fund it. So I think from the U.S. federal standpoint, I don't think there's going to be a crisis in that way. I think there will be tweaks to the tax and this spending maybe for it. But I think, like we said with Japan, their debt to GDP ratio is much, much higher than ours, and they've had no crisis. So I think there are ways to manage that, and the Fed can always buy whatever bonds everybody else doesn't want to, if necessary. But I think overall, it's a question of where do you want to put your resources? Should it be toward supporting the elderly and the sick and things like that, or should it be for other sources? Military stuff, of course, goes up and down, but that's a kind of a permanent fixture of the U.S. budget, and probably will be for quite a while. But so I don't see the federal debt trends as being a source of a crisis, and I think it matters more what you spend the money on and how efficiently than sort of the pure number of dollars. And that if you invest it well, if you spend it well, that's good. You'll get a return for that. If you don't, then you won't. I mean, China's debt to GDP ratio is very low, but their economy is doing very poorly, and they have a big, real estate kind of private sector or local government problem. So I think it's more the private sector, the leverage in the banking system, or the leverage in other parts of the economy that are being the problem, if there is a problem, not the federal government and not the consumer right now. Because, like I say, debt service and debt levels for the consumer are not actually that high, proportional to income.
There seems to be a loss of confidence in the dollar and the debt instruments internationally, at least. In other words, we're seeing central banks overly invest in gold over the last couple of years, and there's been a little bit more benign lack of interest for adding further to treasuries, apart from what I'd consider as co-opted partners such as Japan and the UK, which almost bullied into it. Are these central banks all wrong, or is it just because they're behaving adversarially and there is no concern for the debt, or is there a degree of you've got a day of reckoning coming, and hence it's self-preservational that we prefer to purchase physical gold and have that as insurance against default or substitution by sleight of hand with some inferior contractual issuance, especially given also the perception of how the US is no longer agnostic on its payment systems following the 300 billion treasuries that were essentially confiscated from Russia on the basis of a moral assessment around Russia. So we don't have an agnostic view. Has this not done damage in your eyes, or only slight damage? Or is all the other central banks overreacting? Are the gold bugs getting too twitchy too soon? Where do you stand on that?
No, I think, yeah, I mean, central banks certainly have different goals and motivations than most other investors do, and sometimes a lot of what they're doing is in reaction to trade flows or currency flows and things like that. I think the only problem with the idea of getting out of treasuries or getting out of the dollar is what are you going to go into? What else is there that's big enough and liquid enough and safe enough that you're going to, I mean, the euro would be the only other thing that's even anywhere near. And most people don't have a lot of confidence in that, given that there's no government behind it, there's no military behind it, there's no, it's just the ECB, and that's about it. So nothing else in the world right now, and gold certainly is a tiny market compared to the treasuries market or the the financial system. So there's no way you could have enough gold to serve that function.
That's fixed by price, though, isn't it? If it's around 10 trillion, and it's at or close to highs, were it to go to $3,000 or 4,000, then it's a 20 trillion market cap. It's quite sizable. It's still, as you say, not extremely sizable.
Yeah,
like
inflation will do anything. Yeah, exactly. Yeah, you can make inflate the price and everything is more valuable. But then, again, I mean. So again, I guess, the question is, what are you going to do if you get out of dollars or treasuries? And, what other central bank or country were you going to trust more in some sense and is big enough to handle it? I mean,
none of them. That's, I suppose, the value of gold. It's uncertainty. If you just have it in your hand, you're not trusting any country. It doesn't have a liability attached to it. It doesn't, and you physically hold it, and it's preservational, and it's unique, and it's rare, and it's millennia of history as that. That's why I'm suppositioning, but I could indeed be wrong, that there are these moves in there, and that as a result, there is a structural Armageddon of some form of D-Day with regards to that. It may need an existential crisis to first trigger it. It may not happen of its own accord. But then you could have a degree of contagion then if the confidence starts to be questioned to the degree that some people are suggesting. And it first starts slow, and then it happens fast. It's kind of like whose statement was it regarding bankruptcy? It was happening real slow, and then all of a sudden,
Right.
that's that kind of situation. I'm just testing. For counter opinion value, your relative benevolence of that, I get the feeling you don't see that systemically as being too much of a shadow, certainly short, medium term.
Right. Yeah. And I don't think anything in the short or medium term is going to really drive that. I mean, certainly there could be more demand for gold, but you can't pay your taxes with gold. So there's a structural demand for a currency is driven by what you can buy with it. And so you have to turn the gold into something else, in which case you're involving another currency. Because right now, at least, governments don't accept gold generally for tax payments or anything else. And then you can't go to the store with it. So I think there's a question of, you still have to get back to, be able to buy and sell and do commerce with something. And for now, I think the US dollar is probably going to still be the preferred way to do that. For various reasons, given the U.S. economy size, the U.S. military, and the general safety of the U.S. legal system for commercial purposes.
But it is being eroded a little bit.
No, I mean, having sanctions used too much, it's certainly erode it. But again,
Yeah.
would where else are you going to go? Do you trust China
Yeah.
more? Do you trust, someone in Europe
No,
more? Or Russia?
I don't trust any nation state more easily, not easily.
Yeah,
There
so you
can
have
be
to do
smaller
something.
nations that might be more principled and less erosion, but I can't think of any immediately off the top of the head. That's why the agnostic nature of gold. But as you say, to transact, you would still have to turn it, but you could balance sheet in gold and just keep minor levels of liquidity, households, for example, and just convert some. Maybe it's a bit laborious. That brings us to cryptos. I'm kind of interested if you have a take. I don't get the feeling it's something particularly that you're overly interested in, but you're welcome to give me your opinion. I don't want to assume. Because there's a crowd called Circle that was Goldman Sachs backed at least, and they were saying they want to regulate stable coins. That is a real challenge to the dollar because it's kind of this move around fast without the banking costs associated with transfers through the banking system. It attacks the banking system. I can send you, and you'll get it the same second almost, a stable coin in dollars, which we'd both be happy to receive either way. Do you have a take, given that it segues from what are you going to transact in? That was your criticism of gold to the previous question. Do you see a role here for the current crypto environment, or are you waiting more for the more officious variety of central bank digital currencies, which will then come with all forms of tax certification and various other elements to ensure that everybody's being compliant? How do you stand on crypto?
Yeah, and I mean, you're right in the sense that I have not spent a lot of time in that area, partly because most of the clients that I have for Mill Street Research are kind of more traditional institutional investment clients, and most of them don't have a mandate that allows them to buy crypto. They don't, that's not part of the thing they're allowed to own. And so they have not come to me and asked me to develop, models and indicators or to come up with views on it, because whether I told them, it was a good idea or not, they really couldn't do anything with that anyway. So I think it's still in the process of getting to the point where that's certainly evolving. And now with the Bitcoin ETFs,
with the ETFs, and BlackRock, I mean, a massive asset
futures and
manager.
things that can be done, but most of them still, from again, the ones I talk to have not built it into their kind of framework. And again, these are slow-moving institutions. It's going to take a while to really get this or anything like that going. But I think also they don't have a good way to analyze it in the sense of like a stock or a bond is a cash flow vehicle or whatever. You own a
present values,
company or a promise to pay, a legally enforceable thing. Anything crypto is going to be harder to analyze from that traditional kind of discounted cash flow lens or anything like that. Where how do you put a value on it if there's no direct? So if you can treat it like a currency, then that's one way to do it. In which case, then it's a question of, well, who's issuing them and kind of what do you think about whoever is issuing them?
The faith, the fiat element,
thing like that. And then the other thing is, that I mean, right now, like within the United States, dollars are already basically digital. We can send money pretty quickly and easily in dollars already, and not have to worry about anything else. It's the kind of transnational transfers and things, or if you want to move money in countries where the government does not want you to, then that's kind of where if you're in China or you're in Iran or Russia or Venezuela maybe or whatever, then your
Russian bride.
Right, exactly. You may need a way to get money. They won't let you trade your dollars for your rubles or your yuan for dollars whenever you want to. So you have to find another way. So there's always been workarounds, and maybe this is one of those ways to transfer money, around whatever the regulators or the government wants you to do. The big governments, the U.S. or Europe or whatever, are either going to just allow you to do that as kind of a side thing, but it won't replace anything that's currently there, or they'll stop it in some way. But I think, if the value of it is to work around whatever governments want you to do, it's going to be a harder thing to analyze relative to traditional investments and assets. If its value is being able to get around regulations in some way, then that's a different value proposition and a different way to analyze something than a company or that produces profits, or a bond that's promising you to pay you something.
I understand that. Yeah,
it takes
people
so
out
many of them now too that it's just such a very wide there's Bitcoin, but there's a million other things going on that most people are just not aware of, and it changes so fast. It's very hard to keep up at this point, kind of where the real activity is and what's going to make it and what's going to kind of fall by the wayside and what's a fraud and what's not.
No, I understand, and especially with your positioning in the very traditional market, where fundamental analysis and, as you were saying, discounted cash flow analysis can be done, things can be valued. It's total different game, but I just see it serving some role. It seems that that's an innovation, and in fact, we were referring to AI. There's even some cryptos that have got AI type related significance or are part. So you're getting a convergence and an overlap of a number of ideas coming together that may manifest in a few places, and crypto might be one of them. So that's why it's interesting. Yeah, that's excellent. Threats. In fact, let me ask, a year from now, if we are talking again the same day in February next year, interest rates higher or lower or roughly the same? And what will and any hunch on what the flight path would have been? In other words, down, bottoming, and up, but now higher, or down very slightly, flat, and slightly lower? I don't know. Where do you stand on your expectation? And then once again, we picked up on your differentiation of fiscal stimulus having a bigger effect, but the interest rate question is still interesting for those that are involved in property. Are we still going to be in a frozen property market, waiting either for a crisis and for the sellers to capitulate, or waiting for, a wave of euphoria and for the buyers to capitulate and chase? How's it going to turn out? Many US watchers of our YouTube channel, and they're going to be wondering, are they going to turn out okay in their home, or as buyers, are they going to have to chase and get in, or vice versa? Will the patient be rewarded?
Yeah, I think from the interest rate standpoint, I think rates will probably be lower a year from now. Certainly from a policy standpoint, the Fed funds rate will be lower most likely a year from now than it is now. I don't think we're going to get the, earlier, a couple months ago, the bond market seemed to be pricing in a really aggressive rate cut path. I think they've now kind of adjusted to that, and the Fed has said it's going to cut, but it's not going to cut too quickly or too aggressively unless there's a shock, unless there's some big crisis or something that happens. I think the path, to get inflation back to where they really want to see it, will be, still a gradual one to some degree. And I think the Fed will be a bit cautious about, declaring victory and cutting rates too aggressively. But again, the 1995 scenario says that they don't really need to necessarily, if the economy and the productivity and all that are there. So my view is that rates are not going to go back anywhere near zero or anything like that, anything that kind of extreme. I think it'll just be somewhat lower than they are right now. From the housing standpoint, sorry?
Half an interest rate point, or a full interest rate point, or?
I could see them beating down, 1%, 1 point, from 5.25, 5.5 to 4 something, low fours. Again, without any other big shock, they could certainly support that in terms of still being positive real rates and somewhat tight, just less tight than they are now. And I think that's probably the trajectory that they would prefer to be on, kind of policy wise.
That would imply also a soft landing. In other words, there's been no major dramas. It's been quite measured and slow. Inflation hasn't suddenly flared up, and neither has there been a massive demand-destroying event that has perpetuated an economic crisis. So right. You're pretty much in the soft landing camp by definition in that. Is that a fair characterization?
Yeah, no, I put a note out last month saying the soft landing is here. Inflation is back to target, employment is strong, and we've avoided recession. That's basically the definition of the soft landing. Now, whether that can continue, it's not going to continue forever. Nothing goes on forever. But I think we can kind of keep a little bit of that momentum going, at least through the rest of this year. And to the degree that the Fed has kind of shifted its bias somewhat from the kind of old Phillips curve thing of where the only way to make inflation go down is to make the economy go in recession and unemployment go up. They've kind of shifted away from that because it hasn't worked for decades, really, and certainly not in the last few years. As long as inflation goes down to target, you don't need to see a recession and you don't need to keep rates super high. You can bring rates down to at least a more moderate positive level and still, keep inflation from getting out of hand. I don't see inflation having a reason to go up a lot any further from here, again, unless there's a big shock, another major war or a major OPEC crisis or something like that. I think the general trends are disinflationary, AI being one of them. Technology in general is disinflationary. Aging populations and slower population growth are all disinflationary. Those are all trends that tend to push down on inflation naturally. So supply shocks are really the thing that causes inflation for developed economies and for most of the last 30 or 40 years. So unless we get another shock, COVID or a war or something like that, I think the trend is going to be lower for inflation and therefore for rates to kind of follow along. And then the housing market will probably, kind of not be frozen as much as people adapt to the level of mortgage rates and everything else. And some of the supply comes back on because, yeah, you're right. I mean, a lot of people have fixed rate mortgages. So most of the move in interest rates so far has not actually affected the average rate that people are paying. It's only the marginal new buyer or new seller or whatever that has to pay the current rate. And so it'll take years for that to really flow through the system for 30-year mortgages, for long duration mortgages. And same thing for commercial debt. That's all slow moving. And so I think it'll be, a better market in the sense of activity next year. Whether prices are higher or lower, I don't know. There's still a structural demand for housing. We've been kind of underbuilding for a while now. And so unless building goes up a lot, unless you start getting a lot more houses and apartments and everything else being built, that would cause prices to go down. But mortgage rates alone probably won't.
Right. So actually no great collapse, maybe a slight easing and an increase in activity as new money has to accept what is coming to be understood, probably a turn in the rates, but no huge drama. Would you see the stock market higher, lower, or roughly the same in a year's time?
Probably higher. I would think, just given what I can kind of extrapolate from now, I can say it may be a bumpier ride to get there. But if earnings kind of roughly follow the path that I'm guessing and that we're projecting now, and rates do come down at least some, and inflation isn't a problem, and again, no other massive shocks, I think you could still have room to have the stock market be 10% higher or something. So no huge blockbuster gains necessarily, but no massive losses given the current scenario. Yeah.
And specific industries that you like within that. So for the stock pickers, where would you fish? Which little pools of industry would you say, I'm going to take some of the plums in that area?
Yeah, so right now the kind of favorites have been technology related areas, some industrials and some financials. The financials tend to be more of a cyclical play depending on what's going on in the markets and the interest rates and things. But I think that as long as there's still a decent yield spread for them to lend at, which there still is, and the economy is doing okay, there'll still be demand for loans. I think the financial sector will be decent. And then some of the industrials areas that are going to benefit from all this kind of fiscal support, building the factories and on all those kind of things. And if there is an uptick more in housing development, that will help some of those areas. I think the consumer will hold up, but it'll be a very mixed picture. Like I say, it's been more spending on services and travel and entertainment and things like that, more so than goods for a little while now. That may continue for a while. And so, but things like commodities, energy, materials, utilities to some degree are areas I think don't have much growth potential. They're probably going to be flat to down over the next year. So, I would probably avoid areas like that. And then healthcare.
So the oil price, if I would ask the same question on the oil price, barring a war and anything else obvious, a major demand destroying event around these levels, or maybe a bit softer.
Yeah, no, I think when I looked a little recently, the consensus was about $80 a barrel for end of this year or something. I think I would take the under on that. I would say it's probably going to be here or a little lower. I think the underlying supply demand is very much probably favors supply now, but supply is being restricted by OPEC primarily, and to some degree the unrest in the Middle East and things like that in Russia. But I think there's plenty of oil around. There's plenty of it in the ground. There's plenty of it, available. And natural gas is a good example. Natural gas is at multi-year lows now, at least here in the
terrible.
U.S., because there's no cartel to prop it up. And so you're seeing that, it's not like people don't use natural gas anymore, but there's just plenty of it. Same thing with some other commodities, the demand from China being weak and probably going to stay weak. And that's really where the last 20 or 30 years, most of the incremental demand for commodities has come from, is China. And so if China is not going to be there to do that anymore, China doesn't have to collapse. It's just not going to buy as much incremental new commodities. That's going to keep a downward pressure on the kind of global demand for it, I think. And if Europe's not growing much, China's not growing much, the U.S. is kind of the only place really growing much. Globally, these are all global things. There's just not a lot of demand there. And then technology, whether it's electric vehicles or heat pumps or anything else, are going to kind of incrementally reduce demand over time for a lot of the fossil fuels and other things. I don't see a big bull case long term for most commodities like that.
So it seems technology seems to be the place long term forward to be in, because all the innovation is the
technology broadly defined.
And the more we hate it and the more we expect a commodity bull market, the more we're going to sit and seethe while the technology side continues to go up, despite eye-watering valuations that maybe later will be justified when we have chips in everything. We have a smart system. There's a plan for us, certainly in the direction, and maybe we should be embracing it as the status direction that everything is going. It will be AI. You will be getting a voice telling you the most efficient way to do everything and when and what, and it's going to be the dominant grower. And that puts, where does it, so that would leave things like agris and soft commodities and energies generally bit flat, apart from wars for energies and political discourse. So a bit of a disinteresting area for you as a whole, because some of us have looked at the Bovespa in Brazil. We've looked at the Mexican currency as well. That's done very well for the friend shoring, and we're looking for themes outside of the technology space that seems always so fully priced. But same as Amazon, it always was considered fully priced, even when it was trading at $10. Maybe the exponential era of technology is something that we should all be embracing and overweighting in, instead of waiting for the big crash.
Yeah, no, there's been a lot of kind of money been lost waiting for crashes that didn't happen, and also that technology, anything like that, you do have to be careful about your valuations. Buy on a dip, or wait for something to be at least somewhat reasonably valued. But yeah, like Nvidia is the kind of the latest example. At the beginning of 2023, it was trading at 3 times the market multiple on a forward 12-month basis. It's now having gone up 220%. Is trading at only a 40% premium. It's much cheaper now than it was a year ago, despite tripling. So there are, and the economy, and particularly the technology and networked situation we're in now, means that economies of scale, winner take all, those are much more drivers of things now than they used to be. And so things that are kind of restricted to their physical ability, things like commodities and that kind of thing, are going to find it harder to kind of keep up in some ways. And because technology is always finding better ways to use less physical input to get the same result, technology marching on, whichever companies or whichever technologies they are always going to try to push in a deflationary kind of trend. So I think that, broadly speaking, so shocks and supply shocks basically are the thing that disrupts that periodically. But again, even like Russia invading Ukraine didn't actually stop the flow of oil. They're just selling it a different way.
And in fact, they've done production cuts, as you've already referenced, to almost support the price, which is almost funny. I'm going to finish on one last question, and then we'll let you tell us how people can get in touch. But didn't you find it interesting? And maybe this is, I suppose, where politics and finance sort of collide. That we had a sort of coordinated mainstream media about the West having to potentially even get more directly involved in that particular conflict. This is obviously quite a political discussion now. And it came in as far away as Australia, and insufficient troops and insufficient soldiers, not enough people signing up. et cetera, et cetera. Yet at the same time, we would have the same government spokesman talking about curing inflation and then speaking up the need for Western nations in a very coordinated manner to tool up for probably a much larger conflict. And it was quite alarming to me because it just seemed the two forces were almost working in a dichotomy to each other. One saying we continue to work at winning this war on inflation, but there seems almost messaging coming from governments and the advisory councils that hang around, or the CFRs and all the various others, were quite militant. How do you cross that? How do you make sense of the mixed messages in that yourself? And admittedly, some of this is political and some of it is financial, but they do talk to each other and they are aware of what they're trying to achieve in one area of a department versus the other. It did seem a little bit of a dichotomy.
Well, yeah, you're right. There's a lot of sort of politics and noise around the situation in Ukraine in general and military support and spending versus domestic concerns about inflation or what's going to disrupt supplies. I think, they've tried to, angle policy in such a way that it can hurt the people you want to hurt or slow down the Russians and things like that without disrupting the whole global economy. And so that's why they didn't want to stop oil coming from Russia. They just wanted to not go to Europe and the U.S. Military spending and things like that vary widely, by country. But the U.S. is always going to be kind of the dominant, factor globally there. And so I think, right now, what the U.S. is spending on the military is pretty small relative to, incrementally, meaning for Ukraine, relative to our own military budget or our GDP or anything else. So I don't see that as being a constraint on our financially or on inflation. I think, the question of how best to sort of deal with the conflict in Ukraine is, a bigger picture issue that, will require global coordination and people to get on the same page. I think right now there's a big domestic U.S. political dispute between, Democrats and Republicans trying to argue over that and using it more of as a pawn than our actual policy dispute, which has been the case for a lot of things. Like I say, there's been all the kinds of the debt ceiling and
debt ceiling and the immigration issue, Ukraine issue, and the debt ceiling are invariably peacocking moments for the various parties.
Right. So
absolutely
the underlying, the real problems versus the noise and the politics are very different. And so, one thing gets dragged into another and say, well, we can't do this unless we do that. So I think there's a government dysfunction, which you said kind of operating at cross purposes that you mentioned. That's been going on in different scenarios for quite a while, but it's especially dramatic right now, at least in the U.S. But even overseas, you see that in other governments as well. Wanting to do one thing with one hand and then do the opposite with the other hand. I think that is sort of more of a political issue than a physical or a financial issue. We have the money to spend if we want it, and we have the military that can provide it if we want to. But it's just a matter of wanting to, and then deciding that that's the best way to achieve the larger geostrategic, goals with multiple things going on at the same time. If Israel and Gaza is one thing, Russia and Ukraine is another thing. China, which we're not, there's no fighting going on, but there's we're not selling their our chips, and there's a commercial war going on there, and worries about Taiwan. There's a lot of things to worry about, and so you want to know that the people in charge are, competent, and it's not at all clear that that's the case.
Excellent. Sam Burns, Chief Strategist of Mill Street Research. Thank you so much for your time and sharing your opinions on us. And your good form, let it continue. How do people engage with your services and find out more?
Sure. So millstreetresearch.com, our website, you can get a lot of background information, see sample reports. And there's a blog there that I update, a few times a month. You can sign up for free. Just put your email in the box and you can get it updated every time I update it. And then on Twitter and LinkedIn, I tend to, post fairly often, sharing just examples of comments and what I'm seeing right now So if you want to get a feel for kind of how things look, that's a good way to follow me. And then institutional investors can certainly reach out if you're interested in more in-depth analysis.
Fabulous. And very, very interesting and accurate. And I would also say I love to have a contrarian view. And I would say actually the contrarian people are often right. And sometimes maybe I'm just in the wrong echo chamber, but sometimes we can be a bit too doomsdayish after all. Thank you for your time, Sam, and all the best. And I look forward to having you back on. And just to repeat, it is Sam Burns, and it's Mill Street Research, the website, is it, .com?
That's right, millstreetresearch.com.
We'll put that below for people. It'll come up right now as I speak. Why not jump on and get the blog and get a very interesting opinion that's done very well over the last year. Sam, thank you for your time.
Oh, my pleasure. Thank you for having me on, Francis.